Hello, it's Big Cheds. This is part of the Trading Encyclopedia daily education series on my YouTube channel at Cheds Trading. Find me on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. For today's lesson, we're going to talk about EMA versus SMA. Which one should I use? What's the difference? I have other videos on moving averages, but I wanted to talk about this specifically. An EMA is an exponential moving average. Here I have the 8 EMA. That means there's 8 periods, and the most recent candle has more price weighting than 7 candles before that. So an exponential moving average is more or less more sensitive to the price versus a SMA or simple moving average. Here I have the 50 period, which means all 50 candles are equally weighted, as opposed to the EMA, where the most recent candle has more price weighting. So which one should you use? Well, for long-term moving averages like the 50, like the 200, they should always be a simple moving average, equally weighted. Why? You want it to be a bigger deal. You want it to make more of an imprint or impact on the chart when the price interacts with a longer term moving average like a 50 or a 200. And when you make a 200, for example, an exponential moving average, it's bending towards the price. So when it interacts, it doesn't mean as much as if it was a simple moving average. So short-term moving averages should be, or can be, not necessarily should be, but can be exponential moving average. I have the 8 and I use the 34, and you can look at them for crossing signals. You can look at the 8 crossing the 34. Here it failed a couple times. Some people use the 12 crossing the 26. I use the 8 and the 34. For simple moving averages, many people just use a 5 and a 10, and they use the same type of crossing technique as I use with exponential moving averages, the 50 and the 200 for the golden cross and the death cross. So the rule of thumb is that shorter term moving averages should be or can be an exponential moving average because it's more sensitive to the price. But a longer term moving average like a 50 or a 200 should be a simple moving average, meaning equally weighted. Exponential moving average, meaning more price weighting to the most recent candle. It's more sensitive to the candle, to the price, and it's going to bend towards the price. You're going to get more interactions with it. And that's the main differences between exponential and simple moving averages. And this is part of the Trading Encyclopedia daily education series on my YouTube channel, Cheds Trading. I'm on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. Thank you, everybody. Hope you are enjoying these videos, and I will talk to you soon. Big Cheds out.